Hey, everybody, welcome back to another episode of the Growth Capital Podcast. I'm your host, Justin Dixon, and today we've got Matt Burk. He is the CEO and founder of Verivest, a fund administration platform that he started kind of out of necessity. So this is kind of an interesting podcast because this business was not his kind of real idea to start, except he got reached out to by a handful of people because he was running some funds on his own focused on commercial real estate. And they were asking kind of how to set up a fund and how it all worked. So he decided to actually set up an advisory business. And now he's got 33 employees and he is rapidly growing his business. So we talk about his journey from kind of being running a commercial real estate fund on his own to actually starting a fund administration business. So really interesting episode from Matt. So let's get Matt on the pod. Interested in hearing conversations with private equity leaders, CEOs of private equity-backed companies, and startup entrepreneurs where they share their stories about their career journeys, starting, investing in, and scaling successful businesses, and the important role that having the right talent plays in building a successful business, then you are in the right place. Welcome back to another episode of the Growth Capital Podcast. Here's your host, Justin Dixon. All right, Matt, thank you for being on the podcast, man.
Thank you for having me, Justin. I appreciate it.
Yeah, no, I'm excited to get into some stuff here. But I guess let's kind of set the table a little bit, give the audience a little bit about you and what you're up to right now.
Yeah, I'm founder and CEO of Verivest Fund Services. We are a fund advisory and administration business working with predominantly real estate and private real estate credit pooled investment funds. My background, I have been a fund manager for many years, ran 12 506 Reg D funds over about a 25-year period, so have a deep understanding of what it means to run a fund, and I've translated that into helping other people kind of set up their fund, run their fund, and administer their fund once they get going. So, yeah, that's what I'm up to.
Got it. And where are you based out of right now, Matt?
I live in a suburb of Portland, Oregon.
Got it. That's right. So give me a little bit more context on how your evolution to starting Verivest happened, because I think you obviously had been a fund manager and ran some other funds, but maybe walk us through that journey of kind of being a fund manager and then starting Verivest.
Sure. Yeah, I would say the origin of it really was coming out of the Great Recession. I'm a hard money lender by trade. That's kind of where I started and cut my teeth in the lending space. So was doing a lot of private money loans, brokered a lot of loans in the early days, but then did a lot of private money, matching up one investor at a time. Eventually got to the point where doing enough volume that became challenging. So kind of discovered the idea of doing it in a pooled fund format. 1999, set up my first fund. From 99 till the Great Recession, I did a series of 4 different funds, including a large one with a credit facility from Wells Fargo Capital Finance. Coming out the other side of the Great Recession, Justin, we had to wind down that fund, and through that process, I had a number of other people as that downturn was happening, kind of as it was coming out the other side, looking to set up their own fund, and they were asking me questions about, hey, Matt, I know you've run some funds and had a lot of experience with that. I'm thinking about setting up a real estate fund. What do you think of this? And what do you think of that? So I said, well, hey, there's a lot of people out there that really need that expertise from someone who has done it. So we started a advisory practice helping other real estate asset-based fund managers who had to raise capital from high net worth accredited investors and wanted to do it in a pooled format. We helped architect and structure those funds properly from the beginning to maximize their chances of raising capital and being successful. That's what really gave rise to Verivest. After a lot of those people, and we've done the last 12 years, Justin, we've done about 350-ish funds around the country, everything you can think of, storage, multifamily, retail, office, private money lending, distressed debt acquisition, tax lien certificates, et cetera, et cetera. Once those managers got up and going, then they had to do the back end administration of those funds, because in a fund you have investors and assets coming and going at various points in time. How do you determine who owns how much, and how do you allocate the income and the losses, and that's very specialized pooled fund accounting, and most real estate people, it's not their strong suit, right? So we started doing the admin for them, and then that business eventually grew, and we spun it out, and that's ultimately how Veravest got started, was as an advisory turned administrator, and we've grown, and we now have several hundred clients around the country that are running funds and syndications that use us to help them set them up and to administer them once they're up and going.
Interesting. And are these funds specifically, or do you specifically work with real estate deals, or could you, if somebody wanted to set up a fund for like private equity to buy businesses and things like that? I don't know enough about the different fund structures if it's all the same, or if there's specific things for real estate versus, a private equity or venture fund.
Yeah, there's differences, but mostly the actual capital structure of the fund itself is very similar from a private equity. If they're buying businesses or they're lending, money to operating companies versus lending money to real estate, the fund structure is very similar. The asset type that they're investing in may be slightly different, but the fund structure is very similar. So I would say our DNA and our background is in real estate and real estate credit. But we do some private equity and private credit and so forth. So yes, I mean, you start getting into more publicly traded or interval funds and hedge and that kind of thing we don't do as much of. But yeah, private equity, private credit, real estate, hard money loans, mortgage pools, where we do all of the above.
Got it. And you said that you kind of started your career in kind of hard money lending. I've done some real estate investing throughout my last couple of years, and so the hard money space has always been kind of a weird or not necessarily like something that's very well known about how to lend money to people for deals. Are you doing were you doing a lot of like fix and flip lending? Like, is that where the hard money was going into, and how did you kind of start that whole process?
I would say there's subsets of hard money lending or private money lending, as a lot of people will call it. And there's a little bit different types. I didn't really do a lot of the fix and flips. We certainly did some. But, when I was doing it, Justin, was, late 90s, early 2000s, into the early teens. Fix and flip it was a business, but it's become a much more prevalent business now. And there's a lot of lenders that's all they do is fix and flip. Right. And they're lending the money to the same flippers over and over again and doing construction draws and that kind of thing. We've done some, but our niche was really more commercial property. So we made loans on real estate that was hard for a bank to finance for one reason or another. We ended up doing a lot of owner users. So it'd be someone who owned the business that was in the building that they occupied. And part of the reason for that is oftentimes the reason somebody couldn't get a bank loan had more to do with the fact that in their business, they either couldn't document all their income, or they had a tax issue or a partner issue or something that precluded them from getting financing from a more traditional institution. And that's why they came to us. So that was our niche, was really commercial real estate of all types. We did small industrial, like warehouse facilities, some retail, office, a small, local CPA or doctor office, or we did a lot of taverns and restaurants and various types of real estate that aren't necessarily easy to finance.
Got it. And then at what point did you realize, obviously it sounds like you had an influx of kind of people coming to you, given that you've set up a lot of funds, to the point where you obviously were like, hey, this is a business I should start, because there maybe is a lack of options in the industry for people to find good service providers for setting up and managing a fund. Like, at what point was the tipping point where like, oh, wow, this could actually be a business?
Yeah, I'd say when we were coming out of the Great Recession, we had a credit facility in our mortgage fund at that point. They didn't want to renew the line. I had to negotiate a forbearance agreement with that lender to wind that fund down, wind that line down. And as that happens, basically our mission was to pay off all the loans, pay back the investors. And part of that mission then means your income is going down. So as that was happening, we were looking for, okay, what's our next iteration of this? And I had 3 or 4 people that I knew in the real estate space that came to me and said, hey, I'm thinking about setting up a fund. What do you think of this? And after the 3rd or 4th one, I thought, I had the same issue when I first started a fund. And the only place really, the place people go historically to get the information about these funds are securities lawyers. And securities lawyers are are valuable. They're necessary. You have to have documents that comply with securities law. But the lawyer is one spoke in a wheel the center of which, in my mind, is the manager. So if you think of the wheel analogy, Justin, and I use it a lot, right? If you have there's let's say 8 spokes on the wheel. Legal is one, accounting is one, administration is one, origination of assets is one, managing the assets is another one, raising the capital is another one, investor relations is another one, technology is another one. Right, all of them have to work together in order for the wheel to run smoothly. So as a practitioner, the hub of that is the fund manager, right? So I came at it with a perspective from the middle of that, with legal being one and all of these others. And so I felt like we gave a lot of practical guidance to people to help them avoid mistakes, not spend money on things they don't need, set it up properly in the first place, match their asset model to their capital structure, et cetera, et cetera. And it became something that, the demand was quite high for that in the early 2010s. And we ended up doing a lot of those funds. Part of it originally was the idea that, hey, if we do this also could be a good origination source for our own investment vehicles, because we'll find a lot of managers whose strategies we like, right, that we might invest in and alongside. And it ended up panning out that way. Not exactly, but that was our thesis. So that's how it came about. It was really a direct result of pivoting coming out of the Great Recession.
Got it. And so you said you've been doing it for about 12 years now, I think. And so I guess where's the business at right now? Like, what's the growth plan? How big is the business? Do you have like employees, or like what's it like to be now like a founder of a business?
Yeah, we have about 30 or so people across the company, many of which are accountants and fund accountants and fund controllers and people that do all of the back office work on behalf of our managers. We have some marketing and sales folks and some operation people and so forth. And we're about $3 billion in assets under administration, a little under right now. And I think our target over the next few years is to grow that up to 12, 15 billion or more. And as that happens, kind of look toward building that business. And it's a very, I'd say, that market for a boutique fund administration is what I would call it for new and emerging and middle market managers. It's a very well established market. There's a lot of large players. Mm-hmm. I use the analogy of accountants a lot, right? There's the big four, right? And then there's kind of the group below the big four, and then there's your neighborhood CPA, right, and everything in between. It's kind of the same in administration. There's the big four equivalent, right, of the very well-known names but they cater to the very largest customers and so forth, right? And as you kind of go down, well, I'd say we're boutique, kind of in the middle. We're targeting, a talented real estate and mortgage pool and private equity and private credit folks that want to have a good professional administrator who understands their business well and helps them grow and scale, allows them to focus on what they do best, which is acquiring assets and managing those assets and raising capital.
And is your play or from a revenue standpoint, obviously it sounds like there's some advisory services, so there's more of kind of a services fee structure in there. But then is there technology that you've built that can be leveraged, or are you leveraging other people's technology to kind of supplement?
It's a great question. We've gone back and forth. We did build some of our own technology. I would say that as an entrepreneur, right, you learn lessons the hard way sometimes.
Yeah, right.
That is a difficult business. I mean, I'm a real estate person, right, and a finance person. I understand that business intimately. Technology is a whole different animal. We tried to go down that path. We did build some of our own tech. I would say that what we built was okay, but we just didn't have the same ability to keep up with VC-backed technology companies and so forth. So to answer your question, at this point, where we outsource it, we white label very world-class software that we use for our client base, both for our general ledger system, which does all the accounting and so forth, and also for our investor portal. So it's an option for our clients. We white label it with other providers.
Yeah, I would say, it seems like sometimes it's like, why don't you partner to make it make sense? So if you're not a tech person and you don't want to go out and really,
Yeah,
bang your head against the wall and learn about how to build tech or hire the right people, it's like white labeling is kind of the next best thing so that you don't have to keep up with it, right? Because it's always evolving and there's always
that's right.
updates that go on. And so you stay focused on what you do best and provide the services necessary and work with people that are really good at the tech side,
It's kind of the
essentially.
same argument I make to my clients, right? It's like you want to go out and do real estate deals. You don't want to be a fund administrator or a fund controller, right? It's like I don't necessarily want to be a tech builder and provider. Now it's taken me a number of years to kind of get to that point, and it's been an expensive lesson, but that's where we are today, and we're very happy with the decisions that we've made at this point, and I think our clients are as well. So.
Yeah. And what are some of the challenges, I guess, for you as you think about, you're about 3 billion in assets under management in order to get, to that 15 plus billion, is it just kind of adding more headcount from a sales and marketing perspective to fill the top of the funnel and then, making sure you've got the accounting and finance talent in order to support that? Like what's the push and pull that you can kind of get to that next echelon of growth?
Yeah, I think it's a number of things. I think the most important that we have really discovered here recently is just focus. I mean, we're entrepreneurs. We've tried to do a lot of different things over the last few years. I think in our enthusiasm to try to provide those services to clients to help them set up a fund, everybody wants to raise capital. So we've tried to figure out ways to help people raise more capital. We've put on events. We've tried to build out online directories and marketplaces and so forth, and it's just very, very difficult. So we lost some focus there. I think that's contributed. We grew very rapidly in the beginning on our AUA, assets under administration, and then we kind of leveled off for a while as we meandered around doing some different things. I think at this point, focus is probably the number one thing, and we're already seeing significant increases in our pipeline and our closing of new admin business. That's one area. Second, I think, is getting much more active on LinkedIn. It is an area that we're really spending a great deal of time and effort on, and that's paying off very quickly. I don't think it's a business you need tons and tons of salespeople. You do need some. Another area would be going upstream a bit in terms of the manager size. Right, because a lot of the new managers, one of the challenges with a new manager is that you never know which ones are going to go very far. So if you help somebody set up a fund and they don't raise any money, then you can't really charge any admin fees because there's no money there to administer.
Is that one of the problems that you have? If you go into kind of I'll call it lower middle market, where you've got
yes.
maybe some newer people that were part of a syndication group, and they're like, "Hey, I'm going to raise a fund," and then they think they're great at it, or maybe they were great being part of a team, and now they want to go out and do their own thing, and they come to you and they spend a bunch of money to get it set up, and then they can't fill it with capital essentially.
That happens all the time. All the time. I mean, it's a epidemic, really. I mean, and I'm very upfront with people when they talk about setting up a fund. Hey, it's not for everybody. And one of my first questions is, how do you plan to raise the money? Mm-hmm. Because raising the money is the hardest part. I mean, there's other parts that they don't understand and know, and it's kind of like you can't know fully until you run the fund, but we can help with all of those. The capital raise piece is the one that is the biggest challenge, because making the leap from doing it one deal at a time, even if you're syndicating it with multiple investors, they're still picking and choosing which deal they're coming into versus coming into a fund where the manager's making that choice for them. It's hard. The flip side of it's nice to do it from scratch because you don't have a whole historical bunch of information you have to onboard and import and so forth, and so it's cleaner. But you end up with a lot of them, a significant percentage. They maybe get off. I always say that a lot of them are like the spruce goose. They get a little bit off the ground, but they don't go very far, right? And then some get up in the air and they take off and they hit cruising altitude, and others never do.
Yeah. Yeah, that's interesting. I would imagine, and maybe I'll get your thoughts on this. We've had a fairly stagnant, maybe, or not as kind of robust real estate market, especially in the commercial side over the last few years with high interest rates. And, we see that a lot on the private equity kind of business side as well, again, with high interest rates. But, maybe what are you seeing or hearing as we're recording this in late December 24. So, we're about to start a new year, in a few weeks, I guess. What are you hearing from an investor kind of outreach or outlook for, 2025 and beyond? Is it optimism, or what are you hearing?
Yeah, I think it's a mixed bag. The capital raising environment's been extremely difficult for just about everybody, particularly in the real estate space, but true in the private equity and the hedge space, right? And there's fewer exits. So money has been, enormous sums of money were invested in the late, especially right after COVID when, interest rates were at zero. And that money is tied up in deals, and some of those deals are not going to do very well, and people are going to lose money. And it's just been a very difficult capital raise environment for just about all managers the last couple of years. I think you are starting to see some optimism. I think everybody would like to see more activity and getting more, starting to see some exits and some things, returning some capital and recycling that money. So I think there's cautious optimism heading into 25. I don't see it just rebounding immediately, but hopefully by the middle or second half of 25, you start to see some more activity and so forth. I mean, TBD, right? I think the new administration, for whatever people think about it politically, I think economically, more than not, people have a feeling of, okay, hopefully we're going to see some improvement, right, in the overall economic thing. But that said, with tariffs and other policies, that if it's inflationary and rates go back up, who knows what's going to happen?
Yeah, I think it's to your point, a bit of a cautious optimism, but also a wait and see, right? Because, we never know what's going to happen until it happens. And, sometimes if you, like in 2021, nobody thought that rates would go up as fast as they did. And then they did, right? And so a lot of people, got caught. And to your point, there's a lot of capital that is sitting in deals that likely won't ever go back to the original investor because the deal isn't going to perform well enough to do that. And so you've got probably people that entered the market at that point as a first-time investor that will not come back into the market. And then you've got other people that are, they're repeat investors, but they're also looking for new managers because maybe that they don't trust the person that they got into a deal with in 2021 or 2022.
I think that's all accurate. That's all true.
And as you think about kind of the business side of it, right? So, you went from, kind of running your own funds, and now you run a business that manages funds. How did that transition from, kind of running funds, which kind of seems like a CEO, right? You've got people doing things for you, but now you are a founder and CEO of a services with some tech integration play there. How has that transition been to now having 30 plus employees and, looking to scale?
Yeah, it's happened gradually over time, and I don't think there was any absolute master plan early on. I think the thesis coming out of the Great Recession when we started doing the advisory work was, like I said, that it would be an origination channel for us, and it was. But that business grew, and we spun it out as a separate company. So it happened gradually. I'd say for the most of that time, I had other people at Veravest that were, kind of running it, and I was more in a board capacity, but relying on other folks, to make the day-to-day decisions and even a lot of the strategic recommendations about what we would do and not do. As time went on, with the benefit of hindsight, right, there's some of them that I wish we would have made other decisions. I've gradually gotten more in there, and I think what's happened, to your point, in the last couple of years in our investment business, we've had a fair amount of those challenges that you're talking about. We Fairway runs both funds and syndications. Some of those have performed fantastically, and some are going to perform very poorly. And so it's really been a case of a lot of in the trenches asset management the last couple of years, and not a lot of new deals. And so as that has happened, I have a team of people at Fairway that have managed that process, and that has enabled me to spend more time at Veravest building up this business as the opportunity has presented itself. So a lot of it's market conditions kind of drive some decisions. But I've had running a company and running a business is similar from one to the other. They're very different businesses, right? One's an investment business. You're taking investment risks, and that's a different business than a services business where you're taking no investment risk, but you have to provide quality services to retain those customers, right? So they're different but similar. I mean, to me, it's still a part of the entrepreneurial journey of building and running a company and battling it out every day in an uncertain world and doing the best you can.
Yeah, I would say there's no zero risk when you're running a business because you're risking your time, other people's time, and all that stuff. It's just a different level of, it's almost like direct and indirect risk, right? When you're investing, you're literally, putting money in an investment. And, when you hire people into building a business, you're also taking a risk, and they're taking a risk on you and a bet on you. And so it's impressive that you've been able to kind of grow this business to a certain point. And it sounds like you guys are on track to continue that growth. I guess as you think about, any kind of headwinds going into 25 for your businesses, what do you think if we recorded this podcast a year from now, where would you like to be and what kind of hurdles do you think you'll have to jump over to get there?
Yeah, I think a lot. Well, we have very specific targets for growth on the revenue side and the assets under administration side and so forth. So, I mean, we know what our numbers are. It's really just landing business. I would say it's a competitive market. In the admin space, there's a number of admins out there. So it's how do you differentiate yourself? And I won't say it's a complete commodity business, but it's a lot closer to a commodity business, right, than others. The perception for a lot of clients is that it's basically kind of the same from one to the other. And some of it is, some of it is not. So it's differentiating yourself is definitely a challenge. I think more marketing, getting our name out there, being more consistent. I think being consistent with what we offer, that has probably been our biggest shortcoming over the last 3 or 4 years at Veravest, is that people, what are we, right? Where are we? A marketplace? Are we trying to help people raise capital? Are we an administrator? Are we an advisory company? And that's been a source of confusion for the market. So it's back to my comment earlier, man. Focus is the thing. And I think we should be able to focus. What I really want to be able to do in 2025, focus like crazy on the things that we need to do and execute on that and be able to say that we've grown the business meaningfully between now and that time.
Yeah, what's the saying? If you're trying to be everything to everybody, you're everything to nobody, kind of a thing. And so, one of the detriments to any entrepreneur is lack of focus and trying to, take a shotgun approach and do everything, right? And then you do everything poorly. Whereas if you narrowly focus and niche yourself down, you can do one thing really, really well and build a business that way. I definitely have seen that in my journey as well. Just, trying to, chase shiny objects, and that's never a good thing for an entrepreneur. You need to have a bit of a laser-like focus and stay on the path that you've put out.
Well, and it's easy to get scope creep, right? Because the client that you're providing this service to also needs this other thing, and that's part of their end-to-end solution. And so you try to provide that other thing, and then it goes a little further, and you try to provide that other thing, and now pretty soon, only the biggest companies can really do that well, and even then, they don't do it all up front at once. They gradually get into ancillary markets, right, that are at the outside edges of the things they do, and oftentimes they do that by acquisition. Right. So trying to do that as a small company, I think that has been a strategic mistake that we have made, and we're very much at this point saying, okay, the things that we're not going to be able to execute, let's just not even try, and let's focus on the things that we know we're really good at. And I know we're very good at understanding, people's funds and how to do it and helping them kind of grow that fund and administer it properly and deliver a good experience to their investors.
No, that makes a lot of sense. Have you guys seen a lot of AI being kind of introduced into the fund administration side? And if so, I know that you're not kind of building the tech, so maybe you're relying on your white label provider to kind of implement that or institute that. Are you seeing that kind of come into play as far as helping to maybe streamline the administration part of it or anything like that from an AI perspective?
it's starting to happen. There are definitely providers out there that are getting very active in that business and trying to bring automation, AI, and the use of assessment of proprietary data to lower costs, to provide more information more rapidly to clients. We are trying to do that. We've done a couple of different things with some service providers to attempt to do that. I would say that it's still very much in the early days of all of that, but I do think that's going to happen, and allow administrators and fund managers to utilize their data much more efficiently, and ultimately, hopefully, help keep costs down by being able to automate a bunch of things that historically haven't been able to do it. So yeah, the answer is yes. I'm seeing it more and more. I still think it's very much in the early days, and the time will tell, how rapidly that becomes a differentiator, but I expect it to happen over time.
Yeah. I think it's inevitable. I think there's a lot of people playing around with trying out AI and how it can work, whether it's, implementing better, email marketing scripts in your CRM and all that fun stuff. So I think there's a lot of application. It's just a matter of, when it's appropriate, right? I think some people are trying to smash it into any application just to call it AI, so that maybe they can raise more money. But I think there's a lot of opportunity and a lot of ways to kind of help automate, some of the administrative processes, which I imagine fund administration, just in the name, is there's a lot of administration and things that could be, supplemented with some AI support, as far as that goes.
Yeah. So. Yeah, no, I agree with that. And we're going to do the best we can to stay at the forefront of it, without trying to get too far out over our skis on that, because I think that's another area where we could easily, go too far. So trying to, not miss the boat, but not, be out in the middle of the ocean, all by ourselves, isolated, and not know what we're doing.
Yeah, there's a lot of smarter people that are looking at this than I am. So I'll let them kind of be the first adopter and first implementer. I'm happy to be a fast follower, as far as that goes. So, well, Matt, this has been a great conversation. I appreciate kind of walking us through your journey, from kind of being an administrator of funds and kind of managing your own funds, and then having to start, a business kind of out of a necessity, just based on your network. So I think that's kind of how businesses are kind of built kind of naturally, right? You kind of saw this need, people came to you, and then you said, hey, let me just build this into a business. And so I commend you on that success. I want to kind of end this kind of the way that I end every episode, with a 3-pack of questions. Maybe share, first question here. What is the most influential business book that you're into right now?
Yeah, I'm not sure it's a business book, although it's definitely applicable to business. But the book that is most influential to me in my life at the moment is called The Power of Now by Eckhart Tolle.
Okay.
It's actually, probably a 20-some-year-old book. And I first started listening to it and got a lot of value out of it in the Great Recession, going through some challenging times. And I think kind of revisited that, and it's extremely useful just across, any application of life, about, being present in the current moment and not allowing your mind to just constantly take over your entire being about past and future and so forth. So very powerful.
Yeah, no, I've heard of the book. I don't think I've ever read it, but I kind of think I kind of understand the concept. I just finished a book called The Comfort Crisis, which I thought was really good. Kind of not necessarily a business book, but just kind of, it kind of helps entrepreneurs think about, the way, and it's general for everybody, but from an entrepreneurial standpoint, it's kind of interesting. Cool. What next question is, what's your favorite thing to do outside of work?
Probably, spend time with my family and such, but I ride a road bike. So road cycling is kind of my passion to keep me physically fit, and it's good mental and physical exercise. So yeah, I ride as many miles as I can find the time to do, but that's probably my favorite. I like to play golf too, but that's not as good as cycling.
I've got my road bike back here. I've got it on a trainer, but so I don't take it out on the road super often. But I'm I'm a glutton for punishment to just sit here and watch some TV and spin for an hour. So not as fun to being outside, especially from a scenery perspective, but
less
I live in
dangerous.
Austin. Well, yeah, I was just going to say, I live in Austin, and I know a lot of people that have been hit by cars, riding around. So I'll take the safety over the scenery as far as that goes. So last question here. What is your favorite vacation spot?
Probably where I'm sitting right now, which is Palm Desert area of California.
Okay.
I was born down here and come down here for many years during the winter breaks. My kids are out of school for a couple of weeks, and so I know a lot of people down here. But I'm down here for a couple of weeks for the holidays, so I'm working, as you can see, from down here. It's not a full vacation, but it's definitely a spot that I love to come. So I live in Portland. It's can get a little wet and a little gray and a little dark in the wintertime. So being down here in the 75-degree sunshine is nice.
Yep, I was just up in Pennsylvania where I grew up, visiting some family last week, and it snowed a couple inches and it was below freezing for most of the time. And now I'm back down in Austin and it's like 65 or 70 degrees, and I'm like, yeah, I'll take this right now. That's not a bad trade-off. So totally appreciate that. Well, Matt, man, it's been great. If people want to learn about what you're up to, or maybe they are listening to this and they need some support on their fund administration, what is the best way to kind of get in contact with you?
Yeah, I mean, I'm very LinkedIn is a great place to reach me, connect with me there, or DM me or whatever. You can also email me. It's email address is matt.burk, B-U-R-K, no E on the end, matt.burk@veravest.com.
Got it. We will add that into the show notes so people can easily find all that information and get in touch with you. So, Matt, man, it's been really cool to learn about your journey, and I appreciate you being on the podcast.
Appreciate you having me, Justin. Thank you so much.
Thank you. I hope you found at least one actionable insight from this episode of the Growth Capital Podcast, your one-stop shop for insights from private equity leaders, CEOs, and startup entrepreneurs on starting, investing in, and scaling successful businesses, as well as the role having the right talent plays in growing a successful business. It would be greatly appreciated if you would rate and review this podcast. And if you're watching on YouTube, please like and subscribe and drop us a comment so we can expand the audience of this podcast. Thank you for all your support, and don't forget about upcoming episodes dropping every Tuesday.